Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Niehaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
Hi, everyone. I'm your host, Henrik Neuhaus, and this 11th episode of Total Convexity is being recorded on March the 28th, 2024. Joining me is my co-host, Jim Wang. And we're very glad to be back with another episode. Jim, you have talked about the policy divergences between the major global banks quite a lot recently. Can you give us a big picture overview on where lie these differences, Jim?
Yeah, sure. So I think, during the pandemic time period, we have a synchronized kind of a central bank actions and the fiscal actions for that matter. It's basically we're all easing to deal with the pandemic, right? And a few years later now, now we have some monetary divergence. And as we know, Fed is basically looking to cut the interest rate. Obviously, we can debate when they want to cut and what kind of the data will support them to cut, but their bias is, undoubtedly towards cutting. And ECB, is looking to cut as well. And if you look at economic growth in Europe and the inflation outlook, I would say ECB should have already cut the interest rate already. But I think ECB is waiting for Fed. So you can lump them together, similar time, they will start cutting interest rate and start the easing cycle. And typically Fed leads the other central banks. And this time around, some other emerging market countries have already, started to cut the interest rate. As we know, Brazil and Mexico, they were the earlier one to deal with the inflation and started hiking interest rate, and they started to cut the interest rate already. So Brazil started cutting interest rate in summer last year, and in most recent meeting, and Mexico also started cutting interest rate. So you can see they already started, kind of interest rate reduction cycle. Now, what stands out is two countries. One is China, and the other is Japan. China still is in easing mode to deal with the economic situation there, and particularly the real estate bubble. And we think that they will continue in the easing mode until the growth momentum start to pick up. And then the other one is Japan, and BOJ is on the mode to tighten monetary policy, contrary to other central banks. So in the most recent BOJ meeting, BOJ basically hiked the interest rate by 10 bips. And from 0 to negative to 10 bips, from 0 to negative 10 bips to 0 to 10 bips, right? Positive 10 bips. So basically get out of the negative interest rate regime. They basically hiked the interest rate for the first time in the past 17 years. In addition to that, they also start buying the stock ETF, and they abolished the YCC. And to be sure, it's a small step, but the tightening cycle always started with one small step. And So I think that's the monetary divergence picture that we are, having right now in as a big picture. And where do you want me to go from here?
Well, let's stay with the yen in this episode, right? And talk about the implications of what just happened. Now, you've been presciently bearish on the Japanese yen since the beginning of 2021, and you correctly predicted that the yen's depreciation would serve as one of the best hedges against the risk-off environment caused by higher inflation. This has worked out well, but recently your view on the yen seems to have started to change. Perhaps you could elaborate on why you were bearish on the yen, and now what has made your views change?
Yes. So sure, Henrik. Now, this is a graph actually that we presented at the time, and this is exactly February the 13th, 2021, and that's the time that we were developing the thesis for the Japanese yen to significantly depreciate against the U.S. dollars. As you can see, the yen is around 104.94. And we say, if we have a deflationary shock, yen will continue to strengthen. But if we have an inflationary shock, and we saw yen significantly depreciate, and it's possible to 150. And if you look at the graph, we are at 152, around that level, 150 right now. So I would say this is the 50% of the move of the dollar yen pair. So and I would say during the 2022 stock sell-off, if you were basically short Japanese yen, that's probably the best in the hedges against the risk of environment. So now the question is why we were bearish at the time. So I think the key consideration is inflation. So basically, we developed the inflationary thesis post the pandemic, right? And we think even Japan will experience inflation. And we were saying if inflation materialize, the rest of the central bank, Fed is going to hike interest rate. The rest of the central bank are going to hike the interest rate. And the Japan, because of their unique situation, they are not able to hike interest rate. In that situation, the Japanese yen is going to significantly depreciate, against the U.S. dollar. So this graph shows the Japanese inflation year over year, and in the recent history, we have basically two spikes. The last spike was after Abenomic. If you remember, we have Abenomic. Inflation goes up, it went higher, but it was temporarily. And this time is basically post-pandemic kind of reaction, and it's global inflation. It's not just happening in Japan. And I would say the weakening Japanese yen also exacerbate the problem because they are exporting most of their commodities. And if you look at this chart here, I have this chart here is the interest rate differential of U.S. between 10-year, U.S. government bond versus the GGBs. At the bottom is the dollar yen, and the blue line at the bottom panel. And as you can see, they basically move in tandem. And if we look at towards end of 2020 and the beginning of 2021, and you can see this, basically we saw the interest rate differential bottom out, right? And if this interest rate differential start to expand, then we can imagine the U.S. dollar, to kind of appreciate significantly, right? So what would drive the interest rate differential? And we thought at the time it's going to be the 10-year Treasury. So if you look at this chart on the top panel, that you have the white line is the 10-year U.S. Treasury, and the orange line is the GGB, and at the bottom is the difference between them, right? And as you can see, Japan's GGB is pretty much stable, is almost unchanged. And later we can discuss why BOJ's monetary policy is more is handcuffed, and there's limited things they can do. While Fed have a lot of more flexibility, to hike the interest rate. So as the interest rate expand, and then the dollar, the yen, faced tremendous, pressure, and that's what we have during the time. So what will make that changes? Well, I think the driver will be the reverse of what we have seen, starting 2021. That is, if you look at it here, the interest rate differential between 10-year US dollar and the GGB is basically the highest. I would say all the way, it's during the peak bubble, it's a little bit higher, right? Other than that, it's the highest since the late 1980s, right? So if we do see if we have a growth slowdown, a material growth slowdown in the recessions, and then I can see U.S. Treasury, start to decline, and that will drive down the interest rate differential. And on the other hand, if we have, kind of inflation accelerate to the upside, I would say that, Fed will probably pause and wait a little bit before they can hike. At the same time, I think Japan, the BOJ may accelerate their hiking pace. So I think the risk reward asymmetry here is for the interest rate differential between, for the US and the Japan to be peaking right now. And if that's the case, then I think if you look at this graph, I mean, this white line here, as you can see, kind of this is more in the, similar topping process. And then I think the yen have a big potential to appreciate. So I think that's basically the thesis underlying kind of our assumption and our thesis, or rather, that there is a high probability that the yen is going to reverse the depreciation trend and potentially have a significant rally.
Okay. Thank you. That seems logical enough. So when the BOJ finally then had its meeting last week and we had this hike, the yen weakened. It didn't strengthen, strangely enough. Many argue that this was because the market already was positioned for this hike. So therefore, they buy the rumors and sell the news, or whatever the saying is, right? What's your take on this?
Yeah, so I would say there's a numerous take on this, and I would say, it can be anything else but buy the rumor and sell the news, because there's no buy the rumors. So if you look at this one here, yen did not significantly appreciate. In other words, dollar yen did not go down a lot in anticipation of the BOJ meeting. So this white candle is the BOJ meeting, right? So if anything, they are really close to the weakest point in the recent history, right? And if you look at the futures position, you look at the kind of a vol skew, volatility, option position, rather is very muted. So the question is, does BOJ's action matter? And I would say, why this didn't move a lot. And so I would say there's several explanations for this. One is that the yen's flow a lot is driven by US dollars, right? When people, US dollar is relatively strong because people think, because of inflation, the Fed will delay hiking interest rate. The interest rate will stay higher for longer. And if you're thinking about US dollar, is strong, and you think about which currency to short, naturally you think about Japan, because zero interest in Japan and the trend is very strong. Interest differential between the US is very big. So I think that's the first explanation. Second explanation is that the steps of BOJ that they are taking is just too little to have a big impact. You know, the interest rate differential is still very large. You hike interest rate by 10 bips, you know, that's tiny. It's almost a rounding error. And I think these two arguments have some validity, okay? So they are very valid. I think in the short term, we are really at this very critical, you know, kind of resistance level of dollar yens. And I can foresee this if this break above 100, you know, above this resistance level, you know, call it 152, it can significantly depreciate for a very short period of time. However, I think that will force, probably will force BOG come in to intervene. So I see, you know, there's a chance this go, you know, once it break above 152, you know, hide it higher, and then BOG come in and just smack down. Um, and no, that's a short term, right? And that's not our discussion of our intermediary thesis, which is for the 6 months and the 18 months. And if you expand to that horizon, then I think that this, you know, I think the fundamental may start to play out, in the sense that if the hike is not enough to prevent the depreciation of, you know, Japanese yen, BOJ will do more, because the reason that why they hike interest rate is because yen is becoming, depreciating yen is becoming source of their inflation. Okay, so you know, because they import most of their, you know, of their product, and now if we wait more time here, and I do think that that the probability favors this material slowdown of the U.S., you know, the growth in the U.S. and in the part of the other DM world as well, and this interest rate differential will come in. I mean, obviously, the only problem for that is because I think is because yen is a, you know, kind of a zero interest rate. It's such high carry to long yen. So every day when your thesis did not materialize, you are basically losing money, right? Versus in 2021, and I think the trade was great is because every day your thesis did not materialize, you actually have a positive carry. And now it's a different story. So I think timing is a tricky, you know, it's a tricky things that you need to, you need to figure it out. So I would say, you know, the yen probably will appreciate under two scenarios. One is a material growth slowdown, recession, or inflation acceleration. I think the yen can still, you know, appreciate. And obviously, if we continue to have so-called Goldilocks, you know, kind of scenarios, and because of this carry, and you know, is if the interest rate differential range bound here, then I can see, you know, Japanese yen range bound and with a bias to depreciate. Um, and I think that's kind of the outlook that we have right now.
Okay, so to profit from this, what do you think is the best way to put on a trade so that you can benefit from what you just now described?
So I think, I don't know if this is the best way, but I do think there's a one way. And you know, if you're bullish on Japanese yen, and the question is when, what's, you know, which currency pair, right? So we talk about US dollars. We do think yen is likely to you know, kind of appreciate versus US dollar. But I think against the euro probably make better sense. And even more so, I think in the portfolio construction context, which we can talk about a bit later. And as you can see, this is another chart. On the top is basically the 10-year bond minus the JGBs, right? At the bottom is the you know, euro yen cross. As you can see, they also, you know, move in tandem with the interest rate differential. And most recently, the white line already roll over. You can see, you know, the interest differential between euro area and the Japan starting to turning down. Looks like it's peaking. And based on our fundamentals, we think it is peaking. And if that's the case, then I think the pressure is for euro yen to go down. And also, you know, euro interest rate is lower. the US, so they carry a little bit less, right? Yeah, so this chart is the bond versus the GGBs. On the top of the white line is the bond yield, and the orange is the 10-year GGB. As you can see, it bottomed out during the pandemic, and it peaked out, last year. So I think if we were right about this, then I think the pressure is for euro to depreciate against the GGBs, against the Japanese yen.
Okay, this seems straightforward enough. But if I don't trade currency, say I'm an asset allocator or a retail investor, why do I care? Or if I do care, how do I factor that into my portfolio?
That's right. So I would say, even you do not trade currency, you need to pay attention. And the reason for that is because BOJ is one of the biggest liquidity providers in the past. So we know Fed started QE, and then they handed the baton to Japan once Japan started Abenomic, right? And after European financial kind of financial crisis, ECB started QE, so we started all basically the global QEs, and so this chart is showing the central bank balance sheet of a Fed, ECB, BOJ, and the PBOC. I would say, among this, BOJ is one of the most consequential one, because the PBOC, in China they have a closed capital account, so PBOC can increase liquidity, and the liquidity is trapped domestically. In order for that to transition into the global market, is really through the trading, the trade channel, right? The trade channel is the importing commodities to build the houses, okay, to build the real estate. That was the kind of the channel that how the transmission channel was, was how that policy impact was transmitted to the global market. Now, Japan and the ECB, BOJ and the ECB are very consequential in a sense, because when they do the QE, they weaken the currency, and because the interest is zero, all the money come to the US to seek higher interest rate and higher returns, and because of that, the BOJ's balance sheet expansion and the contraction will impact the global kind of a risk off and the risk on sentiment. And the other one is the status of yen as a safe haven. And people, when people talk about yen as safe haven, you need to understand what does that mean. It means during the risk off scenario, the yen will rally. But but if we look at the fundamentals, yen is the poorest fundamental currency, which we can talk about in the future, which we were structurally bearish. And the only reason that the yen will rally is because everyone borrow yen and invest all over the world. And by the way, that is the best thing you can do, because your borrow currency that is depreciating. So when you return at a lower amount. At the same time, you borrow zero kind of interest rate, and you get invested in any part of the world we have a positive returns. So that's why when anytime there is a risk off in environment in other part of the world where you basically lose your money, then you unwind your carry trade, you return the money back to Japan, and that's caused the Japanese yen to rally. So if you look at the graph here, on the top is the euro yen pair, at the bottom is the VIX, right? So you can see, 2008, the euro yen start to fall out to, have had a big decline, and we have a big spike of the VIX, as we know. And then we have, basically, European financial crisis, and then taper tantrum, right? And in 2007, 2018, Fed started to tighten the monetary policy. The volatility started to pick up 2018, 19, right? And euro yen was really have a big decline. Now, I would say in 2020 during the pandemic time period, euro yen pair was not, did not strong, strongly, which actually we were anticipating that. And the reason for that is because the euro had become a carry currency at the time. So basically people had to borrow euros, and because euro was was falling, and also ECB was doing QE, and interest rate is zero. So people were borrowing euro and investing all over the world, and the euro became a carry currency together with Japan. So that's why during the pandemic time period, for this specific 2020, euro yen, the response is rather muted. Now we think it's a different story because the euro, in Europe, we have a significantly positive, kind of interest rate, and Japan interest is still zero. So Japan is the only, carry, currency. And if you look at this chart here, this is basically CFTC futures exposure as percentage of open interest, and the red line is yen, priced in US dollar. So if it goes down, it's depreciating; goes higher, it's appreciating. And the dotted line is basically the FX speculative position as a percentage of OB interest. As you can see, they have been surrounding, kind of a lower bound for quite some period of time. If you are shorting, Japanese yen, and you long Mexico peso, just an example, okay? Starting from 2021 until today, you would double your money. So, starting from 2021 until today, right? The best investment is not crypto, is not the Magnificent Seven, is not Nasdaq, but Mexico dollar yen currency pair. Okay, the total return, you would double your money in the past 3 years, rather less than past two years and a quarter, right? And that's very powerful. Okay, and given a number, the years we are going on, I think this is very, very entrenched. So if we do have a global risk-off scenarios, and we do think the yen is going to, if the yen is strengthened, a lot of carry trade will unwind, and a lot of risk can happen, especially if you have if you have a growth shock, a negative growth shock. And most recently, I think the yen, kind of, outside of the U.S., the Nikkei's, or topics, Japanese, equities outperformance has caught a lot of people's attention. And we look at the kind of equity risk premium as a U.S. investor. We look at equity risk premium around the world, and this is the Nikkei's dividend yield hedged back to U.S. dollars, okay, minus U.S. triple B. And we were looking at the time, in 2022, rather, I think it's September 2022, October 2022. This is one of probably the only one, if my memory serves well, have a positive equity risk premium, and also is above the long-term moving average, right? And then, and the Japanese, from this perspective, you basically get to 5% of the carry by shorting the Japanese yen, in addition to get a dividends yields in Japan. And by the way, the risk premium of Japanese equity versus that domestic market is very depressed because you have a GGB close to zero. And I think that's part of the reason why, Buffett did the trade. I mean, what Buffett did is basically issue the Japanese debt and buy Japanese equity. Basically, Buffett was short Japanese bond and long Japanese equity, right? And that definitely have worked out remarkably well, right? Now, if I look at the chart here, is basically the total return ratio of S&P 500 versus the SPY versus EWJ. EWJ is denominated in yen, versus the SPX divided by Nikkei, total return local index. right? So the blue line shows the S&P significantly underperformed Nikkei, right? In the so Nikkei denominated in Japanese yen, right? And the white one, if you look at it, basically it has been range bound, right? The SPY versus EWJ, they are stuck in the range, and depending what time you look at it, one may outperform the other. And now, so if you are long Japanese equity, let's long, Japanese equity and short the currencies, right? And then you would have done very well, right? But if you didn't do that, invest in Japan versus invest in the US is probably similar outcome. And depending on what time you are looking at. So I think the currency does play a very important role in this case. And so I think that's the reason why I think the investors need to care.
Okay. Let's talk about time horizons a little bit here. So your views or your scenarios, you always associate them with particular time horizons. So if the fundamental macro drivers play out as you currently expect, you believe the yen is likely to strengthen over the next 6 months to a year. However, you also have a structurally bearish or even very bearish view on Japan. So how do you reconcile these two seemingly contradictory views?
That's right. So I have learned that you can talk about the macro all day long, but do not talk about direction of the market. And if you talk about the direction of the market, do not talk about time horizon. And so I'm the only idiot who will talk about the macro, or will talk about the direction of the market and time horizon. So I've already discussed the short term, in the next really near term, in a 1 week or 2 week, the dynamic of the US dollar and the Japanese yen, how would that behave? But I think the purpose for this one is talking about intermediate term from 6 months to 18 months, as you pointed out. I do think that we can have a significantly pullback. Okay, so maybe pull back to 125, maybe 120, around this area, right? And then I think we probably will have another wave higher of the dollar yen. In other words, the yen depreciate. And I think that ultimately, in the very long run, I think 125 is 250, right? It's basically my target. And the reason is very simple. Japan have a Plaza Accord in the 1980s, and that's started the appreciation of the Japanese yen. It started in 250, and it went all the way down to 80. I think we will have a round trip, going back to 250 and more, potentially depreciate significantly more. And that is a significant depreciation, right? So if I look at the yen to US dollar, so this one is just reading the opposite way, right? Going lower. It's going lower is basically the yen, depreciating. Going higher is the yen, appreciating, right? So this is the Plaza Accord moment, and I think if we go back to the Plaza Accord moment, and it would depreciate another 40% from the peak to trough, and that's the depreciation of 70%, and maybe more. And the reason for that, and maybe go back to 70s, even a lot lower, and 200, 300. And the reason for that is because in the very long run, we have to look at what is matters for the currency, right? So we're talking about currency is buying and selling pressure, right? So the buying pressure coming from portfolio flow and also coming from basically current account surplus, right? And the aging demographic, typically in the long term, we have an aging demographic in Japan. and that's typically associated with the deteriorating current account because you consume more, and you produce less. And what's unusual about Japan is very high debt to GDP ratio, where they have a 270%, debt to GDP, and therefore it's very difficult for them to tighten hike the interest rate. Okay, and BOJ already own the half of the GDP market, and I think eventually they will own 70, 80, almost the entire the market, or the rest of them they will just using the financial repression and force the other financial institutions to own them. In other words, they are on the way of a permanent monetization. The so-called abolish YCC is just temporarily. It's basically interest rate is really low. I mean, actually, they didn't abandon it. They basically just say, if this increase a little bit, we don't care. If you increase significant amount, they will come in and buy unlimited amount of GGBs. Okay, so that is on the table, and because you have such a high, debt to GDP, right? And in addition, because of the population, right? You have more social wealth spending. You have less people earn their tax revenues, and it will have downward pressure on the budget balance as well. So, if you look at this chart here, the best Japanese budget surplus was in 1980s, right? At the at the peak of the bubble, 2%. Okay, and we have a basically wave of big deterioration of the budget. One is tech bubble, the other one is after financial crisis, the subprime financial crisis, and the third one is after pandemic, right? And they reached close to 10%. So kind of a budget balance. Okay, so with 200% of the interest with 200% of the 70% of the GDPs, right? And let's just say you normalize interest rate to 5%, the same as the US, right? And your interest rate payment is going to be 13.5, right? 13.5 of your revenue. Okay, now the Japan tax revenue is 12.5 of the GDP. Okay, so you have to spend the entire revenue or the entire government revenue just to serve the interest rate payment. Obviously, you cannot allow that to happen. So in other words, the BOJ have to prevent the interest rate from go to that level, and the way they prevent it is they have to buy it. And when they buy it, if there's a global inflation pressures, right, and that will force higher inflation, and if you hike interest rate, then the problem will become, then the rise at that point, beyond that point, then the hike of interest rate will no longer be a effective tool to deal with inflation. And why? Because when you increase your interest, and you're basically you need to issue more debt just to cover that interest payment. And because your debt level is so high, the BOJ has to come in and buy that debt. In other words, BOJ have to print money to just pay the interest rate expenses. Okay, beyond that point, I think this will become a vicious circle, and then the inflation will go higher. So a lot of people talking about, the deflation is a kind of a natural destiny for aging population, productivity growth, which I agree. The human nature, in the end, is, humans' productivity, right? It's basically deflationary. Okay, we learn how to do more productively over time. The culprit is not productivity, nor is aging population. The culprit is the government will spend the money, and the government spend the money. A lot of time they do not generate productivity, and when they have gone to a certain level, and the government will, the central bank have to come in and monetize it, and that's the time you enter basically the way of no return. Okay, so I think Japan is at the forefront of it. And by the way, I would think that that the rest of the countries are not far away.
Well, this certainly is sobering, and it really almost sounds like a large version of a Greek financial crisis without Germany to come and bail them out. So do you think the US will end up following in Japan's footsteps towards the abyss?
Yes, I think the whole world is doing that. By the way, you mentioned Greece, right? Greece is smaller countries, and if they have an independent monetary policy, and that will be exactly what they do. They will just depreciate the currency by 70, 80%, and that's it. They're done. Okay. But because their currency is euro, then they have to get a physical transfer from Germany. And if Germany does not authorize the physical transfer, and they still stay with the euro, what you get is basically depression. Now Japan have it's a sovereign countries. They can, they have the physical and the monetary policy. It's in a unified government, so they can do whatever they can do. And just remember, in the 1930s, Japan was the first one basically started this, abandoned the gold standard. They started that monetization, and the industrial, kind of took off, and everything was doing well. And then towards the very end, I think their international bond traded in London just drops, a lot. But the domestic bond, because the BOJ was supporting that, yield was still relatively low, but inflation was getting out of control, and they did a lot of military spending. And the next thing you know, they started World War II. And I'm not saying that's something that's going to repeat. But when you have a very high inflation, have a regime shift in monetary policy, a lot of things can happen. I certainly don't think that the scary things is going to repeat. But people always say that history rhymes, right? Now here in the U.S., I think we look at the Fed policies, stock market and this and that. If we just step back, okay, and just look at where we are in the history, several things that we can point out. One is our debt levels is only exceeded by 1940s, all right, and a time that basically the U.S. is fighting the World War II and issued bond to fund the war. We were only able to get out of it through yield curve control. So the government says, 10-year, treasury interest rate will not go above, I think it was 2% at the time, but I could be wrong. But don't quote me exactly on the levels. But we have the yield curve control, and by the way, the U.S. is emerged as the winner out of World War II, and I hope we don't have a World War III, right? And then if you look at another, but we don't have the yield curve control, official yield curve control yet. If you look at our asset valuations, there's only two periods the asset valuation exceeded our current time. One is the peak of tech bubble, and the other is 1929, right? But in the year, during the peak of tech bubble at the time, inflation was a lot lower, right? And there's a tremendous, productivity gain through the internet, actually that result in the surplus. One can hope that AI can boost the significant productivity gains, but the recent, economic growth was due to the deficit. So during the tech bubbles, we have a surplus, and right now we have one of the basically worst physical deficit with the historically low unemployment rate. And during the 2020s, right, China just joined the WTOs, and during the not only they create tremendous kind of depreciation, kind of deflationary, kind of pressure for disinflation, I would say, for the U.S. and also the DM countries, but also they basically, as a way to compress the currency, they come back and use that surplus to buy the U.S. Treasury, so compress the financing cost here in the U.S. as well, or you can say compress the, artificially enlarge the equity risk premium in the U.S. as well. So that is in reverse, and that creating the disinflation pressure, and now that is in reverse right now, right? So that's another time period that we can compare to. And obviously, a lot of people compare our current inflationary, kind of episode to the 1970s, which we actually did that comparison. And in 2020, we just came back from the first wave of inflation, and the central bank basically believe, that they can deal with inflation. I mean, the common commentary is basically, yes, if there's inflation, that's not a problem. We know how to deal with that. We just hike interest rate. Look, Volcker, they just hike interest rate and kill the inflation. The only problem is during the time, that GDP ratio in the 1970s is very low, and so you can hike the interest rate to a very high level. There's not a problem because of the debt load, and try to do it right now, and um, and I think that because we basically has crossed the Rubicon in terms of the budget spending, right? Before pandemic, we are around 100%, right, debt to GDP, and right now is 120% debt to GDP. The Carmen and Reinhardt, I mean, they did the research. Once your debt GDP ratio above 100, and then you're basically on the way of no return. And judging from right now, I mean, we have a record low unemployment rate, and that's typically the case that you should have, budget surplus or close a very low budget deficit. However, we have a big budget deficit, right? And in that case, I think imagine that if you have recession, your budget deficit is not going to be 6%, 7%, 8% anymore. It's going to be 10, 15 to 15%. And once you issue, we have already seen when you have a lot of debt, when you issue that debt, what can cause to the yield, right? And think about the UK moment, right? The gilt moment, and once that happened, BOE have to come in. And also think about the SVB moment. After SVB, Fed have started the BTFP facilities, right? And the Fed balance sheet actually temporarily just increased, although they were, telegraphing to do the QTs, right? And just think about what caused the interest rate to come down in October last year, and that's because Yellen pivoted, right? They started to not to issue the long-dated bonds anymore, and they want to, issue a lot of short-term T-bills, and that short-term T-bills can be funded essentially by the money market funds, right? Which park the money with Fed. So I would say yield curve control have already happened, right? Since pandemic has already happened. I mean, they spend a lot of money, and as a matter of fact, the magnitude of the Fed balance sheet expansion is equals to the magnitude of the fiscal deficit in the U.S. Okay, in other words, Fed just need to come in and monetize them, so I think YCC is the final destiny. It will only intensify in the long run. The way is that how you navigate through this, and we would say, it is not linear, right? And I would say here is the following sequence is very important. So in the sense that when you have a high inflation, then they will try to tighten the monetary policy, stop monetization. In other words, start a QTs, right? And then once the interest rate once that causes a problem, right, cause recession, they will pause and then they will revert. I think this is easy to say, but navigating through this is tricky. And we have always on the views that the Fed will tighten the monetary policy until there is a recession, and the government will not spend money. With record low unemployment rate, they will spend money during the rainy days in reaction to the unemployment rate and all those things. This world is changing, so the reaction function is very difficult. The bar for them to do that is very low. So that's lesson what we have learned is that anytime they have threatened financial stabilities and etc., then they will just come in and save the day. So I think how to it's easy to say, and how to navigate it is difficult. But in a sense, this dynamic that we are talking about will stay with us. And for now, we actually do think that the higher interest rate will slow down the U.S. Kind of economy materially. Probably will have recession, and then I think you will see large government response, and will push to another kind of a level of data monetization. So I think that's the world that we're heading.
Okay, Jim, thanks. I think we've now come to the end of this 11th episode of Total Convexity. Let me try and summarize what you have said. First, the yen has the potential to strengthen over the next 6 months to a year and a half. And this strength would be then driven by monetary divergence, or the differences in central bank policies. And the second point is that because of the enormous debt burden of the Japanese state, which leads to an even modest increase in coupons to become a significant additional burden on the budget, therefore, in the long term, you are not bullish on the yen relative to the dollar. Because of these debt problems, the matter of fact is that every fiat currency may face significant depreciating pressures relative to real assets. So this is not unique to Japan, right? Yield curve control and quantitative easing seems to become the name of the game in the long term, not only in Japan, but also in the US and then possibly in the Eurozone. And this will have profound implications on all broad asset classes going forward. That's it.
Yeah, no, that's a very good summary, Henrik. So tell us where listeners can follow us.
Sure, you can follow us by searching Total Convexity in your favorite podcast app or via YouTube. Please don't forget to click on the subscription button so that you will be automatically notified when a new episode is available. You can also follow us on X, where we have the handle @TotalConvexity. You can also email us at totalconvexity@gmail.com, and you can follow our insights on Substack at totalconvexity.substack.com. We promise never to spam you or to provide any kind of advertising or marketing. We will try and give you our honest take on the market, which will be right or wrong, but we'll try and make it short and sweet. Anything else, Jim?
I think that's it. Thank you, everyone. If you like this podcast, we would appreciate if you can pass along to anyone who may be interested. This concludes episode 11 of our podcast, Total Convexity. See you next time.
Disclaimer: the information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.